The current price of ZIM Integrated Shipping Services Ltd. is sitting at exactly $18.76 USD, representing a sharp decline of $1.07 USD, or roughly 5.40% on the day. If you are looking at that red percentage and thinking this is just another standard shipping cycle pullback, you are missing the single most important narrative unfolding in the industrial sector right now. The expectation for ZIM has always been straightforward. It is a dividend cow when rates are high and a cash-burning trap when rates are low. That is the expectation, but the reality is far more aggressive and dangerous. What we are seeing today, this 5.40% drop, is not about freight rates normalizing or the Red Sea crisis finding a resolution. It is the market trying to price in a hostile, chaotic, and high-stakes battle for control of the company itself. We are no longer just looking at a shipping stock. We are looking at a takeover target, a proxy war, and a boardroom siege, all happening simultaneously. If you are holding ZIM in your Fidelity brokerage account or watching it on your Robinhood app, you need to understand that the volatility you are seeing is not technical, it's existential. Let's look closer at the price action because the tape tells a story that the headlines are burying. ZIM opening at 19.75 USD and flushing down to an intraday low of 18.56 USD before settling near 18.76 USD indicates massive institutional distribution. Volume is heavy, over 4 million shares traded, which tells us that the smart money is positioning for a binary outcome. The rumor mill is currently on fire with reports that MSC, the Mediterranean shipping company, has submitted a bid to acquire ZIM, potentially competing with Hapag-Lloyd. When you have giants like MSC circling a $2.3 billion market cap company, a 5% drop seems counterintuitive, doesn't it? Usually, buyout rumors send a stock ripping higher. The fact that ZIM is down suggests the market is skeptical a deal will go through, or worse, that the internal proxy fight between the current board and the dissident shareholder group is going to scorch the earth before any sale can happen. Investors are scared that the strategic review is a smokescreen and that the payout, the massive special dividend everyone on SoFi Invest is clamoring for, might never materialize if the board digs its heels in. This brings us to the core conflict, the board versus the dissidents. Expectations were that ZIM would continue its asset-light model, chartered ships, flexible capacity, and high payouts. The reality is that ZIM has pivoted. They've invested heavily in 46 new-build vessels, including 28 LNG-powered ships. This is a capital-intensive shift. The dissident group argues that management is destroying value and that the cash on the balance sheet should be returned to you, the shareholder, right now. The board argues that shipping is cyclical and they need that cash to survive the next downturn. This tension is what is driving the stock down today. The market hates uncertainty more than it hates bad news. If the dissidents win the vote on December 26th, we could see a massive one-time cash strip dividend. If the board wins, we continue with the long-term fleet transformation. This binary risk is why you see the stock trading with the volatility of Tesla stock rather than the stability you might expect from a legacy industrial player. Speaking of volatility, I want you to take a second and think about your own position size here. Comment below how many shares of ZIM Integrated Shipping Services you currently hold, and tell me, are you voting for the board or the dissidents in the upcoming proxy meeting? I want to see where the sentiment is among retail investors versus the institutions. Now, we have to talk about the macro backdrop because ZIM does not operate in a vacuum. The Red Sea crisis has been the single biggest tailwind for ZIM over the last 2 years. We expected these disruptions to be temporary. The reality, as we head into late 2025, is that the diversions around the Cape of Good Hope have become the new normal. This extends transit times, soaks up excess vessel supply, and keeps spot rates artificially elevated. For a company like ZIM, which has significant exposure to the spot market, unlike Maersk or Hapag-Lloyd who rely more on long-term contracts, this chaos is profitable. However, the market is forward-looking. The fear driving the stock down today is the realization that if the geopolitical situation stabilizes, or if the global economy slows down further, the massive influx of new tonnage hitting the water, not just from ZIM, but from every major carrier, will cause freight rates to collapse. The SCFI, the Shanghai Containerized Freight Index, has been volatile, and investors using interactive brokers to trade freight futures are betting that the supply glut will finally overwhelm the demand, regardless of whether the Suez Canal remains blocked. To understand why this matters, we need to look at ZIM's business model, which is distinct from its peers. Historically, ZIM was asset-light. They didn't own ships, they leased them. This meant that when the market crashed, they could just return the ships and cut costs instantly. It was the Uber of shipping. But that model has evolved. They're taking delivery of those 46 new-build vessels I mentioned. These are big, expensive, state-of-the-art ships. They are more efficient, yes, and they lower the cost per slot, which is crucial for competing on the Trans-Pacific trade lane. But they also increase the fixed cost base. If you're sitting at home using Schwab Intelligent Portfolios to manage your risk, you know that high fixed costs in a downturn is a recipe for disaster. This change in business structure effectively changes the investment thesis. ZIM is becoming more like a traditional liner, with all the heavy assets and liabilities that come with it. This transformation is painful, and the market is punishing them for the growing pains today. Let's contrast this with the retail sentiment. On platforms like Robinhood and SoFi, ZIM is often touted for its dividend yield. At one point, the yield was north of 100% annualized during the peak of the pandemic boom. That memory lingers. Investors see the stock at $18 and think, if they just pay a $2 dividend, I'm making over 10%. But you have to be careful with this logic. The dividend policy is variable. It's 30 to 50% of net income. If net income drops because rates fall or because they are fighting a proxy war, the dividend disappears. We saw this in 2023 when they paused payouts. The reality check here is that you can't treat ZIM like a bond proxy or a steady payer like Apple stock. It's a levered play on global chaos. You're buying a ticket to a geopolitical lottery. If the Red Sea stays closed and consumer demand in the U.S. holds up, ZIM prints money. If peace breaks out or the U.S. consumer taps out, ZIM burns cash. There's also the Israel factor. As an Israeli company, ZIM faces unique geopolitical risks that its European and Asian competitors do not. We have seen targeted protests at ports, we have seen specific threats against their vessels, and we have seen the stock react to news coming out of the Middle East. This adds a risk premium to the stock. It trades at a lower multiple, often a PE of 2 or 3 compared to peers, simply because of this headline risk. Today's 5.4% drop could also be partially attributed to renewed tensions or specific threats that algorithms pick up before they even hit the mainstream news wires. Institutional algorithms trading on interactive brokers platforms react in microseconds to these geopolitical keywords, often flushing the stock before a human trader on a Fidelity mobile app can even refresh their screen. Let's look closer at the financials because the Q3 2025 report gave us some critical clues that explain today's weakness. While they generated adjusted EBITDA of nearly $600 million, which sounds great, it was a massive drop from the previous year. The margins are compressing. The cost of chartering ships is still high because they locked in ships during the boom, but the revenue per container is falling. This margin squeeze is what the bears are focused on. They see a company that is still profitable but is on a glide path to break-even or loss-making territory if 2026 brings a recession. The dissident shareholders know this, which is why they are pushing for a sale now. They want to sell the company while it still has cash and profitable operations rather than wait for the bottom of the cycle. If you are a long-term holder, you have to ask yourself, do you trust CEO Eli Glickman to navigate this transition, or do you want the quick exit that the dissidents are promising? The sale narrative is particularly interesting. The rumor that MSC is bidding is credible because MSC is on a global buying spree, trying to consolidate dominance. Buying ZIM would give them a massive foothold in the Trans-Pacific and a modern LNG fleet without having to wait for shipyards to build new ones. However, regulatory hurdles would be immense. A merger of that size would trigger antitrust reviews in the US, EU, and China. The market knows this.